Hi, everybody, and welcome to Debt-free Divorcee, formerly known as the Peace and Power Podcast. Today, we are getting you prepared for tax season, and we are joined by our guest, Miss Gianni Logan. Gianni is a 15-year corporate accountant who has managed the financial operations of a multi-million-dollar corporation and now operates a successful accounting and business consulting firm. Gianni, thank you so much for joining me today.
Thank you for having me, Kiosha. It's my pleasure.
Yes, of course. This is such a huge topic in general, right? Like, it's that one thing that we have to do every year. We know that it's coming, but somehow always feel unprepared. So I think that this conversation will be very beneficial, not only for divorced women, but also just for the general population. So we'll dive right into it. It's obviously tax season. The first thing is just, are there any changes to the tax code or laws that people need to be aware of as they're getting ready to file their returns this year?
There is, and there's actually one that's perfect for this conversation and for your platform. Let's say you have a situation where your child's father or mother claims your child without your knowledge. Okay. That happens to a lot of people, believe it or not. And so you go to file your tax return only to get a rejection because you find out that that social security number, your child, has been claimed on another tax return. So previously, when that's happened, there's really been no way for the parent who probably rightfully should have claimed the child to get the situation remedied, to where they can claim the child, because it's kind of like, okay, your word against his, and the IRS is not getting involved in all of that, right? And so now there's a new regulation that states that if the parent applies for an identity protection pin, okay, so an IP pin for short, if you apply for an identity protection pin and you file your tax return claiming your child, even if your child appears on another tax return, the IRS will honor your tax return because you have the identity protection pin.
Wow. That right there is going to make a lot of people happy, and it's also going to make a lot of people mad.
And so I know people may be wondering, like, well, how do I apply for an identity protection pin? So you can apply for one online. You can go to the IRS website. In the search bar, just type in IP pin or identity protection pin. You can apply for it online. Now, one thing is that normally when you apply for an identity protection pin, once you use one to file your tax return, you usually have to use it every year, and it changes. Every year it's a different pin. However, with this new rule, you can choose to apply for a one-time identity protection pin and just use it this one time. If you think, okay, this is probably the only year I'll have to deal with this. And then every year you can choose to do it again.
That really resonates, because I know a lot of divorced families have a situation where they may claim the child one year, but then their ex claims the child on an alternate year. And so being able to get this pin on a temporary basis can kind of protect you for the year that you're filing and claiming the child, but doesn't necessarily prevent the other spouse from claiming on the year that they're supposed to. I kind of want to talk a little bit about that particular nuance for divorced families, where you may have it written in your child custody agreement that you claim on 1 or 2 years, and then your ex gets to claim on the other years. What do people need to do aside from this temporary uh, protection pin? What do you need to know as a parent who may be in your off year or your year that you're claiming the child? Are there any things that you need to do to prepare differently to file your taxes in those years?
So I would say it depends on the relationship that you have with, the child's father or mother, right? Because there is a form that you can attach to your tax return. It's not mandatory. It's Form 8332, and it's for the non custodial parent. And basically, it releases the right, it makes it official that you release the right as the custodial parent to the non custodial parent to claim that child. So there's another criteria where two people can claim the same child. Okay. And that gets a little bit confusing. A child could be the qualifying child of both parents. And one of you agrees that I'm going to claim the child as the qualifying child. So I get the earned income credit. I get all these other credits, but you still get to claim the child for the sake of having a dependent, because when you do that, now you can be head of household, which helps you because when you're head of household, that standard deduction is higher for you than it would be for a single person. So you still get to benefit from claiming the child. You just don't get all the credits for claiming the child.
Let's go back for a minute and just level set some basic tax information, because some of the women and men who may be listening to this may be their first time filing taxes on their own as a single person, or their first time doing it in a really long time. And so, can you just give us the general lay of the land in terms of like filing statuses? I used to be married filing jointly. Now I may be head of household or whatever. What are those different filing statuses? What do they mean? And what are some of the things that you need to look out for if you're going from one to another?
So we have single, head of household, married filing jointly, married filing separately, and then there's also one called qualifying surviving spouse. In the situation of someone who is recently divorced, which one do they fall under? So you may fall under single, you may fall under head of household, you may fall under married filing joint, or you may fall under married filing separate. And so I'm going to break them down individually, starting with married filing joint. So obviously, married filing joint means that you and your spouse are still married. It could also mean that you and your spouse are not married, but you don't have a final divorce decree, okay, by the end of the year. Or a legal separation agreement by the end of the year. Okay. So if you don't have that, then technically you're still married. Okay. And you should file married filing joint. But there may be circumstances where that is not feasible. Let's think of someone who is dealing with domestic violence, where they had to flee the situation, but they're still legally married. Well, that person may not be able to file a married filing joint tax return. So what are their options? So they can either file as married filing separately, which you do have to meet that qualification. So when you file married filing separately, it typically means that you and your spouse have lived apart. And you only have to have lived apart for the last 6 months of the year to qualify for married filing separately. Okay. So that's one of the main criteria for married filing separately. But then with married filing separately, you run into something else depending on where you live. If you live in a community property state and you file married filing separately, you may still have to report 50% of your spouse's income on your tax return, okay? Depending on whether or not it's considered as community income. Now, there's always exceptions, to every rule. If you, again, have no knowledge of the income that they earn, if you are not part of a joint bank account or anything like that, where you saw the money, you knew what they were making. So then that would qualify you not to include it. If you're a victim, domestic violence, you're not required to report half of their income. And so those are like the primary criteria that would exempt someone who lives in a community property state from having to file 50% of their spouse's income on their tax return. So you basically just had to have no knowledge of what they earned or in a situation where it wasn't safe for you. So that's married filing separately. Also with married filing separately, there's some other very important things to know. So it's not a favorable tax filing status at all. And so when I say that, you lose a lot of credits when you file married filing separately, unfortunately. Yes. So some of the credits that you lose are that are decreased. So you either lose them or they're decreased. Like for example, if you have a child that's in daycare, okay, so typically you could claim the child daycare credit, dependent care credit. But if you file married filing separate, you're not able to claim that. Let's say that you contribute to a flexible spending account. Like some people have a flexible spending account through their job where they contribute money specifically to pay for childcare. So normally, in a normal situation, you can deduct up to $5,000 that you contribute to that dependent care flexible spending account. If you file married filing separate, you can only deduct 2,500. Another big one is the earned income credit, which a lot of people who earn a certain amount of money, usually below what is considered as poverty level, you probably qualify when you file your tax return for a earned income credit. It's the credit that gives a lot of people a tax refund. It really does help. And that's its job. It's to subsidize the fact that you didn't earn a lot of money. Well, you lose your ability to claim the earned income credit unless you have a child that qualifies you for it. So it's almost like you're penalized for married filing separate. There are circumstances where it may be beneficial, but I haven't seen one yet.
Wow.
So, yes, yes. So that's married filing separate. But again, the key thing to remember is that if you don't have that final divorce decree, you don't have that legal separation agreement, but you lived apart from your spouse the last 6 months of the year, you can file married filing separately, even though it does have unfortunately, all of these other negative consequences. And then you could file single. So a single person would be someone who does not have a dependent. Okay. So if you don't have a dependent, then you have to file as single. And then, of course, head of household. So I always say that head of household is the best option because, as I just explained, married filing separately comes with so many negative consequences. So if you have a dependent, whether that be a child or a dependent could be someone you're just taking care of, like a parent. So if you have a dependent, go with head of household.
Right. Okay. Wow. Taxes are it's just so complicated. There's so many nuances to it. So I'm so happy that we're having this conversation. And to get into the weeds a little bit more, we have the conversation of like the standard deduction versus the itemized deduction. And I remember my mom when I was little, like keeping a shoebox full of receipts in the closet. And I always felt like, "Ooh, Imma have a shoebox full of receipts when I get older." And now I'm like, "I don't wanna keep all these receipts." So,
Want anything to do with that
I don't
paper.
want anything to do with the
Right.
receipts.
No, I understand. I understand. So yeah, so that's a good question. So standard deduction is easy. Standard deduction is a deduction that all of us gets from the IRS. We have the choice to take it or use it rather when we file our taxes. The purpose of it is to decrease your income that you're taxed on. So for example, if you make $100,000, from your job, but you are a single person. In 2024, your standard deduction is $14,600. So instead of paying taxes on 100,000, you'll pay taxes on 100,000 minus $14,600. So that's the purpose of it. It's to help us pay less taxes. Then there's itemized deductions. Itemized deductions are those things that, well, for example, I'll just say things that you spend money on that you get to take a deduction for. Some of the biggest ones are mortgage interest. So, mortgage interest is an itemized deduction. Charitable contributions is an itemized deduction. Medical expenses that you pay for out of your pocket that are not reimbursed to you, you can itemize those. So, that's probably what she was keeping receipts for. You can also itemize state and local taxes. So, when you go to the store, you go to Walmart, if you keep all your receipts, you can actually take a deduction for the state and local taxes. The thing is, most people don't want to, like you said, keep those receipts, the box of receipts, right? So it's like, I got to keep all these receipts during the year. Most people are like, I'm just going to take the standard deduction. Okay. Instead of keeping all of those receipts. But I mean, if you add up your mortgage interest paid during the year, and you add up your charitable contributions, which also include tithes paid to your church, and you add up your medical cost and you keep your receipts, if it exceeds the standard deduction, then you actually could benefit a whole lot more from itemizing. If it exceeds the standard deduction, because you're always going to use the one that's highest.
Some of the people who are listening to this, going through a divorce recently, the money may be a little tight. hiring an accountant just is not in the budget, right? And so they're looking at TurboTax or some of these other tax softwares that are out there to try to kind of DIY their taxes. I have definitely done some DIY, some DIY taxes in my day. And so, what kind of advice can you give to somebody who is going to try to do their taxes on their own just because they can't afford to hire you?
Right. Understandable. So my advice to them is that if they're going to use a software and do it themselves, just to pay attention to the questions that are asked. Because it's going to ask questions. And if there's something that's complicated, like my software knows, okay, this is a complicated topic, there's going to be like a little note that you can click on to read more about that topic to better understand it. And so that would be my advice is just, take your time going through the questions. Hopefully you use a software that does have, additional notes for you to understand. Some of the softwares actually link to the IRS. Like in my software, if I click on a certain topic that I want to learn more about, it'll actually link me to the IRS publication that talks about that topic where I can read more about it. And the IRS, I mean, they have a whole publication. If anyone's interested in reading it, I read it all the time. Even like as a 15-year accountant, I'm still reading it because when it comes to claiming a child and determining who gets to claim the child, it can get very complicated. But it's publication 501 if anybody's interested in reading it. But there's a lot of charts and it'll say, okay, like for example, you may have a situation where the parents are trying to figure out, well, who gets to claim the child? Okay, well, in that publication, it tells you how many nights did the child stay with you during the year? How many nights did the child stay with the other parent during the year? Okay, well, if the child stayed with the parent, more during the year than they did with the other parent, that person has a right to claim the child. Then it'll have a scenario that says, well, what if they stayed with both parents equal number of days during the year? Then what do you do then? Okay, well, then it'll say, well, it's based on who makes the most money. So there's so many different like nuances and just little criteria that you have to look at, especially when there are children involved. So I know I kind of went off talking about, using the software on your own, but those are some of the things that you may run into when you're doing your own taxes that you're not quite sure of. And so hopefully you use a software that's going to link you to the IRS to help you better understand these things.
Wow, girl, listen, because because I'll be honest, like taxes scare me. Like the IRS
I see
scares
why. It's,
me.
it's a lot.
You know,
I'm
like
an accountant, and I'm
I
like,
don't want
it's
to
a
get
lot.
it wrong. I don't want to mess with them people. I want to get them their paperwork right. If I owe them money, I want to get them their money. Like I don't want to have nothing to do with the IRS. Like, you know what I mean? So all of these little nuanced things is like this is important because the IRS don't play. Like I'm not trying to get arrested because I found the wrong worksheet or whatever. You know what I mean?
Right, right. And I want to talk about that for a little bit because a lot of people fear the IRS. And, I really want us to get rid of that fear of the IRS, fear of money, all these things, right? Because these are things that are a part of our life. Taxes are a part of our lives. And so we do have to understand them. We don't have to understand them to the degree of an accountant, but we do have to have a basic understanding of them. And I think that so many people fear the IRS and it keeps them stifled because there are business owners who say, well, I don't want to make a lot of money because I don't want to pay taxes. And it's like, well, so you're going to hinder your earning ability and your ability to potentially build wealth and have financial freedom because you have a fear of taxes or you don't understand taxes or so forth and so on. That's why there are people like myself, who are experts on the subject matter who can guide you through this so you don't hinder yourself, because you have this fear of the IRS. And so the tax code actually was designed to benefit business owners. I'll say that for sure.
Mm.
And so, especially if you're a business owner and you're listening to this and you're like, well, the IRS scares me. But it's designed to benefit you. So you benefit from understanding taxes. I always say it takes all kind of people to make the world go round. It takes all kind of business owners to make the world go round. I don't need to understand everything that my doctor does or, I just trust my doctor, right? And I go to my doctor when I need. But I don't fear, going to the doctor. I don't fear, doing my annual, if you're a woman listening to this, your annual exams that we have to do. I don't fear those things because I trust my doctor. And I know that I need to do those annual exams so that I can make sure that I am good, that I'm healthy, that I'm preventing things, that I can catch things, in advance. Same thing with taxes. So it's like, if you know that you want to have financial freedom, you want to build wealth, then you can't avoid the subject of taxes. You just need to try to understand it or connect with someone who can help you to understand it and understand how it can benefit you. And then also the IRS, you have to do a lot for the IRS to really come after you. Some people do a lot and they still don't come after you because they can't keep up with everything. But if you made a mistake and you didn't file a form, worst case scenario, if you get audited or examined, as I prefer to use, then you'll have the opportunity to correct that situation, but nothing to fear.
I love that perspective, Gianni. Like for real, that is such good perspective. Because I think, sometimes you hear in the news, you like such and such got arrested by the IRS. Like you hear these stories and it's like, I don't want nothing to do with them. I just don't want like I don't want to get in trouble, you know? One more thing for the divorce people specifically. What all is taxable income? Like if you're getting alimony, if you're getting child support, is that income that you need to be reporting to the IRS? I mean, some of it you might be getting cash, you might be getting cash app. What does that look like and like what do people need to do?
So child support is not taxable. Okay. And after 2019, alimony is not taxable either. Now, let's say you're listening to this and you're like, okay, but I have an alimony agreement in place and it precedes 2019. And what does that mean for me? So that means that your alimony, 50% of it is taxable income to you. And just like the person paying you alimony, they get to deduct 50%. So if you're the person paying alimony and your alimony agreement was in effect prior to 2019, then you also get to deduct 50% of the alimony payments that you're making to someone else. Let's say that you have an alimony agreement in place that existed prior to 2019, but after 2019, there was an amendment of some sort to the alimony agreement. Well, that revised your agreement and that made it fall under the new rules, which state that starting in 2019, alimony is not taxable and it's also not deductible to the person who actually pays it.
I want to talk a little bit about what happens once you actually file. So, you filed your taxes. Let's say, heaven forbid, you owe on your taxes, but you're not able to pay. And you just mentioned, working with the IRS. What are the options out there for people who maybe need a payment plan or like what can you do in that scenario?
So you can definitely apply for a payment plan online, and it depends. So the length of the payment plan will depend on how much you owe, in terms of how long they allow you to pay it off. You can apply for a payment plan online. Typically, what I do with my clients when they owe, I always send them the link directly to the IRS website. Where you can see all of your different options. So there's installment options, and so there's all types of options available to individuals or business owners who owe money to the IRS. Now, interest is going to accumulate. So, it's like, and the IRS does charge, yeah, they will charge interest. So, of course, the longer, you take to pay it off, the more interest accumulates, but there are payment plan options available. Yes.
Let's say somebody is listening to this and it is like April 10th and they are right at it. We right on the deadline. We're not gonna make it. They said, I ain't got my paperwork together. I'm not gonna make it. What do they need to know in terms of filing an extension? Like, you don't want to just not file it, right?
Correct. You definitely want to file an extension. When you file an extension, it gives you additional time to file your tax return. It does not give you additional time to pay taxes owed, which doesn't really make sense because how will you know how much you owe unless you file? Okay. So it doesn't really make sense. But the IRS, I guess they said we want our money and we want it when it's due. Okay. And so yes. And so figure out, right? Figure it out. And so, but when you file an extension, you will have an option to make a payment towards any amount that you owe. And they encourage you to do so. So even if you don't know how much, you expect to owe, just make a small payment towards it. You can actually incur penalties for not paying your taxes on time, even though you filed an extension. So you can have a late payment penalty, even though you filed that extension giving you 6 months. And so, I always tell people, unless your situation changed drastically from the prior year, let's say you owed the prior year, maybe just pay what you owed last year if your, income situation is about the same.
Wow. Okay. Well, that thank you for that.
Yes.
Because it's somebody out there who goes through the whole paperwork process. They know they owe money, and then they're like, "Oh, I can't pay this right now. Let me just file an extension." They think
Right.
filing the extension
It's
means
going
that
to
they
give
don't have
them
to pay.
absolutely, nope, not at
Yes.
all.
Last question, I think, unless you say something else that's gonna have me like, "No, I got more." So let's say a person has filed, and then they listen to this, and they're like, "Oh, wait, Gianni is speaking, and there's some things I didn't know. I wanna go back and make a change. Let me pull that back." What do they do?
They can file an amendment. So you can amend your tax return for 3 years from the date you originally filed it. So yes, so you can file an amended tax return. You can actually now do that online, which is amazing. Let's say that you forgot to include your student loan interest, and you want to include that because you're like, okay, I want to get a credit for my student loan interest. So you just go back and you add your student loan interest and you just refile it. And so it's usually for individuals, it's going to be a 1040X as an X-ray. And again, you can file that online. If you're using a software, your software should have the option for you to file that amendment through the software. And if not, the IRS actually has a new free file. Well, they've been having it a while, but they've been pushing it a lot. It's an option for certain individuals who make below a certain amount. I don't know the threshold to file your taxes free. So if you go onto their website, you can just type in like free file and you can probably file that amendment through there as well. But yeah, you have 3 years to file an amendment.
Wow, this has been so amazing. I'm going to actually, in the show notes and description, there will be the links to all of these wonderful resources that you are giving us. And Gianni, I just want to thank you so much for your time. This has been so amazing. Please let people know where they can find you and how to reach you if they want to work with you.
Yes, so you can find me on Instagram. My handle is FitFabAccountant because I'm really big on health and fitness. And so
I love it. Fit, fab, accountant. And honey, you look it, we can tell. Thank
thank
you
you so
so
much.
much. Oh, this has been such a treat. Thank you, thank you, thank you.
Thank you for having me.